Hello everyone. Welcome to the short lesson video on International Accounting Standard 7 Statements of Cash Flows for Cambridge A-Level Accounting. Before we proceed, please note that abbreviations are used in this presentation only due to space constraints. Abbreviations are strictly not allowed in the Cambridge exams. Let us now look at the importance of cash flow. Cash flow means the cash coming in and the cash going out of the business. It determines the ability of a business to pay for its immediate liabilities, that is, the liquidity of a business. If a business is unable to pay its lenders or trade payables on the due date, it will be declared insolvent and it may be forced to close down. It is easy to confuse the terms profit and cash. So, are they the same? Profit is not equal to cash due to the following reasons. Profit calculation involves non-cash expenses such as depreciation, loss on disposal of non-current assets, provision for doubtful debts, and these expenses do not involve cash outflow. Profit calculation involves certain non-cash incomes like profit on disposal of non-current assets which do not involve inflow of cash. Similarly, accrued expenses and incomes due this year are included in the income statement as the current year's expenses and incomes, but they do not involve any cash outflow or inflow in the current year. Prepaid expenses and incomes paid this year for the next year will not be shown in this year's income statement, but they do involve cash inflow or outflow in the current year. Dividends paid are not subtracted to arrive at the profit for the year, but they will be subtracted while calculating net cash flows. Do all successful businesses have a lot of cash in the bank? Well, even if a business is successful, it may run into liquidity problems because of several reasons. A successful business will invest heavily in non current assets, thus causing huge cash outflow. But these non current assets will not generate immediate sales. Therefore, there is no corresponding cash inflow. This may cause liquidity problems for the business. The business may have excessive inventory in its warehouse. Thus, cash is tied up in the inventory, again causing liquidity problems for the business. The business may also give too much credit to trade receivables. If your customers are taking too long to pay, cash is tied up in the customers, it would cause liquidity problems for the business. If the business has been unable to negotiate a longer credit period from its suppliers, then again the business will have to pay the supplier sooner, causing liquidity problems for the business. The definition given to us by IAS 7 states that a cash flow statement is a statement which shows how cash inflows have been generated and how these have been spent. At this point, I would like to draw your attention to the link that the cash flow statement has to the income statement. The cash flow statement will use the profit derived from the income statement and show us how much of that profit has generated cash and what has happened to the cash during the year. Another important thing that you must remember is that the cash flow statement must be produced by limited companies as part of their financial statements with the income statement, statement of financial position, and the statement of changes in equity. There are four parts in the format of the cash flow statement. The first one is the operating activities. These are the main revenue generating activities of the business, mainly dealing with current assets, current liabilities, depreciation, payment of interest, and tax. The second part is the investing activities, which deal with the acquisition and disposal of non current assets and other investing activities. The third part is the financing activities. This is concerned with the issue of share capital, the payment for the redemption of shares, changes in long term borrowings, that means loans. And the fourth part is dealing with the reconciliation of opening cash and cash equivalents with the closing cash and cash equivalents. Cash and cash equivalents mean the cash in hand plus the cash in bank minus bank overdrafts. Let us now do a quick revision of the concept of profit from operations. You have been given some information on the screen, and using this information, you have to find out the profit from operations. As we know, revenue minus cost of sales gives us gross profit. From that, we will subtract the administrative expenses and the distribution costs to arrive at the profit from operations. Note that non-cash expenses like depreciation, loss on sale of non-current assets, provision for doubtful debts have been included in the administrative expenses and have been subtracted to arrive at the profit from operations. Also note that taxation and interest have not been subtracted to arrive at profit from operations. Hence, profit from operations is also called profit before interest and tax. We will now take a look at the format of net cash flow from operating activities, which, if you remember, is the first section of the cash flow statement. Always remember that the cash flow statement begins with the profit from operations, and the first section of the cash flow statement ends with the net cash used in or from operating activities. We will add the depreciation and loss on disposal of non-current assets to the profit from operations because these are non-cash expenses. We will subtract the profit on disposal of non-current assets. If you see here, this figure is in brackets, which indicates that it is subtracted. Any increase in current assets means that our current assets owe us more now. We have lent them money. That means cash is tied in the current assets. And that means that we will have to subtract that figure because more cash is tied in the current assets now. Any decrease in current assets means that our current assets have paid us back and they owe us less now. And this means that cash has been released back into the business. Any decrease in current liabilities means that we have paid back our current liabilities, leading to a cash outflow, hence a negative figure. Any increase in current liabilities means that we have borrowed from others, and that means it is a cash inflow, hence a positive figure. Once you have added all these figures, whether they are positive or negative, you will come to the net cash used in or from operations, which is this figure. And from this, then you will subtract the bank interest paid and the tax paid. Why are we subtracting these two figures? Because profit from operations was profit before interest and tax subtraction. And so now we will subtract the interest and tax from the profit from operations. So once we have subtracted these two figures from this figure, we will arrive at the net cash used in or from operating activities. Now that we have understood the format of the first section of the cash flow statement, let us solve a sum on the same. On the screen before you, you have been given some information. Using this information, you have to calculate the net cash flow from operating activities. We will start with the profit from operations, which we had already computed. The figures are the same. We will then add back the depreciation which has been given to us in the question. It is $30,000. We will then add back the loss on sale of plant and machinery. The original cost of the plant and machinery was $20,000. It had been depreciated by $15,000. Therefore, the net book value of the plant and machinery is $5,000. It has been sold for $3,000. That means it has been sold at a loss of $2,000. So we have calculated the first three figures. Let us now look at the increase or decrease in our current assets and current liabilities. Our opening inventory is $5,000, closing inventory is $6,000. That means our inventory has increased by $1,000 during the year. Our trade receivables has reduced by $2,500 during the year. And our trade payables have also reduced during the year by $900. As we had discussed earlier, any increase in our current assets will be subtracted. Any decrease in our current assets will be added and any decrease in our current liabilities will also be subtracted. Once we have added all these figures, we will get the net cash from operations. From this, we will subtract our interest paid and our tax paid. But here in this case, we don't have any interest paid, so we will just subtract the tax paid, 12,600. And now we are left with the net cash flow from operating activities, $140,000. We know that our cash flow statement's starting point will always be profit from operations. But what if you are not given the profit from operations in a question? For this, we will have to revise the format of the income statement. In the income statement, profit from operations minus finance costs gives you profit before tax, from which we will subtract the tax to arrive at the profit for the year. So suppose you are given profit for the year in a question and you have to arrive at the profit from operations. You can find it out by using the equation profit from operations is equal to profit for the year plus finance cost plus tax. What if you have to find out profit from operations from retained earnings? For this, we will have to do a quick revision of statement of changes in equity. I want you to focus on this column. You can see that in the retained earnings column, opening balance of retained earnings minus final dividend paid minus interim dividend paid plus profit for the year gives you closing balance of retained earnings. Written in equation form, closing retained earnings is equal to opening retained earnings minus dividend paid plus profit for the year. Rearranging this equation, profit for the year is equal to closing retained earnings minus opening retained earnings plus dividend paid. That is, it is equal to increase in retained earnings plus dividend paid. Let us now look at a sum to find out profit from operations when we are given retained earnings. We have been given retained earnings on 30th April 2020 and we have been given retained earnings a year later on 30th April 2021. We have been given the dividends paid during the year and we have been given the interest payable and the taxation. Now we have seen in the previous slide that when we have to find out the profit for the year from retained earnings, using the formula increase in retained earnings plus dividends will give us the profit for the year. So increase in retained earnings in this case would be 1,170 minus 1,125. That means an increase of $45,000 plus dividends, that is $30,000. That is giving us the profit for the year of $75,000. Now that we know the profit for the year, it is very easy to find out the profit from operations. So profit from operations can be found out by profit for the year plus taxation plus interest. That is a profit from operations of $135,000. So what did we do here? We found out the profit from operations when we were given retained earnings. Now this is May-June 2011 paper 4.2 question number 1 for those of you who want to solve a sum on this. So that was part 1 of Statements of Cash Flows IAS 7. We will deal with investing and financing activities in another video.